Hi everyone, welcome to my presentation on consumer planning. So, on the first slide, we were defining what consumer planning is and why it matters in words today. Consumer planning is the process of making smart financial decisions in areas such as spending, saving, borrowing, and consumption. In other words, it's about taking control of your money so that instead of letting your finances run you, you run your finance. This is especially important now when there are so many ways to spend or borrow online. So, we walk through each bullet. For the first is, its easy access to credit and online shopping increases the need for proper planning. With one click, we can buy almost anything or apply for a loan. Without a planning, it's easy to lose track of how much we will spend or borrow. Without planning also, individuals may face overspending, debt, and financial instability. That means you could end up with credit card balances you can't pay off or not enough money for essential expenses. For the third is, encourages goal settings, budget, and responsible money management. When you set clear goals like saving for a vacation or paying off a loan, you can build a budget that keeps you on track. Last but not least is, play an important role in shaping long-term financial behavior. It is a good habit today, like tracking every ringgit, become the foundation for greater financial success down the road. Now, we understand what consumer planning is and why we need it. So let's look at each core purpose and importance. So for this next slide is focus on the practical benefits of consumer planning and how it helps us reach our financial goals. So basically, consumer planning helps align financial decisions with current income and future needs. It promotes financial discipline, encourages protection from fraud, and supports long-term financial stability by guiding consumers to make smarter and more confident financial choices. Put simply, it is not just about today's purchases, but it is about making sure each decision fits into your bigger life plan. So I will explain about each bullet. For the first one is promote responsible use of credit and borrowing. It teaches you to ask, do I really need this loan and can I afford this repayment before taking on debt? It also helps build emergency savings and long-term investment. It is by regularly setting aside a small amount, you create a safety net for unexpected costs and grow wealth for future goals. It also increases awareness of scams, misleading, and unfair pricing. When you are actively planning, you are also more likely to question deals that seem too good to be true and avoid fraud. It also reduces dependency on high interest rate, which means you have budgeted for emergency and know your real spending capacity. You are less likely to turn to payday loans or high interest credit. It supports financial independence and clear decision making. Ultimately, consumer planning gives you confidence, which means you know where your money goes and why, so you can make choices without second guessing. So that wraps up the background and purpose of consumer planning.
Next, I will continue to present to you use and misuse of the credit, which is before we make a major purchase for the credit, we need to have a question for ourselves whether we have cash for the loan or do our savings enough to pay our debt. So, first, we need consumer planning because it can help to prevent credit misuse. When people plan ahead, they are less likely to overspend or fall into debt trap because they understand how much credit they can realistically handle. Second, it supports smart financial decision. With proper planning, individuals can assess whether they can afford a purchase, whether they should use a saving, and how it fits their overall budget. And the next one, it is align a credit use with a personal goal. When you follow a clear budget, you are likely more to use credit only for a thing that are truly support your financial priorities, like essential purchase or long-term investment. Next one, consumer planning also consider opportunity cost, which is it encourages people to think critically. Could the money or credit be used better as well, or can the purchase wait? And for the next one, which is another important aspect for is that planning account for emotional impact. Financial stress from debt is real. Planning does not just deal with a number, but it will help you prepare mental and emotional for repayment responsibility. We also, planning consumer also strengthens your long-term financial health. When credit is used wisely, such as for the education, housing or starting a business, it can actually help to improve your financial position over time. And then lastly, consumer planning promote empowered decision making. It gives individuals to have the confidence and a knowledge to make a responsible, informed choice that leads to the lasting financial stability.
So, I will present and explain how to develop an effective plan to manage debts by looking at 4 key parts, which are the key strategies, the common reasons for debt, signal of debt problems, and the action plan. First, let's look at the key strategies. If you ever face difficulties making payments, it's very important to notify your creditors immediately. This helps you discuss new payment arrangement or solutions to avoid late fees or legal actions. Also, under the Fair Debt Collection Practices Act, if a debt collector contacts you, you have the right to request debt verification within 30 days. If debt is verified, you can decide whether to settle it or dispute it if it is not correct. Next, let's see some common reasons why people get into debt. So, some main causes are emotional spending, wanting instant comfort or gratifications, and relying too much on installment plans. Family miscommunication about money and high finance charges can make debt grow quickly. Social pressures like trying to keep up with others' lifestyles or overindulging children can also add to debt problems. Now, how do we know if debt is becoming a problem? There are clear debt problem signals or warning signs. For example, only paying the minimum balance on credit cards, delaying or missing payments, using savings just to cover daily expenses, or taking new loans to pay off old debts. Other signs included having no emergency savings, depending too much on overtime pay, or even delaying important medical care because of money problems. Finally, let's talk about the action plan. To manage debt well, we need a clear plan. Start by tracking all your debts and expense carefully. Prioritize debts with high interest rate first to avoid extra costs. Always communicate with creditors early if you need help, and avoid emotional or unnecessary spending, and if needed, don't hesitate to get advice from a trusted financial advisor. By following these steps, we can manage debts wisely, reduce financial stress, and also build a more stable financial future.
I will start with discussing about the first article, which is preventing household matters. So basically, the effective money management rule is known as 1-2 rule. The articles discuss 3 main financial problems that many people face. First, a lot of people struggle with high debt, like credit cards and loans. If not managed properly, this debt can become a big burden and lead to bankruptcy. Second, many people have little to no saving as they often delay saving until it's too late, and when something unexpected happens, like losing a job, they don't have any backup. Third, there is a poor income planning. Without proper budget, people tend to overspend, especially students and families with a lot of responsibilities. So, to help to solve these problems, the 1/3 would suggest to divide your monthly income after tax into 3 equal parts, which 1 part goes to paying off debts, 1 for saving or investment, and 1 for daily needs like food and bills. So, by doing this, you can reduce your risk of bankruptcy. save more over time, and handle your money better. The article says these rules can help to lower the chance of bankruptcy by around 20 to 30%, which shows how useful and effective it can be. Now, we move on to the statistical information that support this rule. A graph from this article shows that after the 2008 financial crisis, bankruptcies in the US increased sharply, but later started to go down. This suggests that better financial planning, like using the one-third rules, help people avoid going bankrupt. So the article also shows how the rule works to different types of household. As for a single income household, it can reduce the risk of bankruptcy by 30%. For dual income household, it's about 25%, and for multi-generational families, the risk goes down by 20%. This means the rule can help all kinds of families to manage their money better and avoid financial problems. In conclusion, the one-third rule is a simple way to guide your spending, saving, and debt management. It is easy to follow and very helpful, especially for young people and families who want to plan a more secure financial future.
For the second current issue is the rise of BNPL in Malaysia. So what is BNPL? Buy Now Pay Later, which is BNPL, is a growing digital financing tool in Malaysia, allowing consumers to make purchases and pay over time, often interest-free if paid on time. So for the growth in popularity, BNPL usage is expanding rapidly across the country due to its accessibility and user-friendly structure. For the consumer behavior, the ease of deferred payment may lead to overspending or poor financial discipline, particularly if users fail to manage multiple payment plans. This is the statistical information for the issue. For the first statistic is overdue payment versus outstanding debts. Outstanding BNPL debit is increasing, showing growing adoption, and overdue payment rates are declining, suggesting better repayment habits and stronger controls. And for the second statistic is debit composition overview. BNPL makes up only a small portion of total household debt, while personal loan and higher purchases are more dominant, indicates low systemic risk from BNPL despite rising usage.
So we continue for this slide, which is how consumer planning play a vital role in improving a person's creditworthiness based on a 5C credit. First, we have a character. This refers to a person's financial reputation, whether they pay bills on time and meet obligation. Through proper consumer planning, like budgeting and tracking expenses, individuals can develop strong habits that lead to the positive credit history. Next, we have a capacity, or in a simple way, is the ability to repay a loan. Consumer planning helps individuals to understand their income and debt limit. This allows them to avoid over-borrowing and maintain a healthy debt-to-income ratio, making them more reliable in the eyes of the lender. Third, C is a capital, which is a person at work, including saving and investment. With effective planning, people can build their assets steadily, showing financial strength and lowering lending risk. And the fourth C is we have a collateral, which is referred to the valuable asset used as security for loan. Through strategic planning, individual can acquire and maintain assets like a property or bicycle, which can help them qualify for a larger or lower interest loan. And for the last C, we have a condition. Where we can control the economy, planning allows individuals to prepare for uncertainty through emergency saving, insurance, and income diversification, making them more resilient and trustworthy to the lender. In short, consumer planning strengthens every aspect of credit evaluation and increases the chance of loan approval.
Next are formula of measuring credit. There are two types formula of measuring credit, which are debit payments to income ratio and debit to equity ratio. For the first one is debit payments to income ratio, which is a monthly payments divided by net monthly income. For monthly payment is not including house payment, which is a long-term liability. And consumer credit payments should not exceed a max of 20% of net income. Next, debit to equity ratio. Formula for debit to equity ratio are total liabilities divided by net worth, but for the net worth is excluding the home value, and the answer should be less than 1. So basically, what are the formulas for? These formulas will create for credit worthiness checks. Usually, lenders use this ratio to determine how they likely to repay a loan. A lower ratio is a lower risk. So for the second one is better money management. These ratios guide consumers in budgeting wisely, ensuring that spending on debt does not exceed safe limits. And why these formulas are important? So for the first one is standardized evaluation. The formulas provide a consistent method to evaluate credit risk for everyone, regardless of income or lifestyle. And the last one is help in decision making. Both consumers and lenders rely on those formulas to make informed financial decisions, such as applying for a loan or granting one.
The first recommendation is to address the issue of high household debt by encouraging individuals to limit borrowing essentials only. It means that reduce the unnecessary spending, especially through credit or BNPL schemes. Follow the wanted rule, where income is equally divided into 3 parts, which is wanted is for debt repayment, savings, and living expenses. The second solution that could solve the problem is encouraging savings and emergency funds. One effective way is automate savings, where a portion of income is automatically transferred into savings account each month. So this will remove temptation to spend and help individuals to protect themselves during emergency like job loss or medical expenses. The last recommendation to reduce bankruptcy is improving income management by creating a monthly project and consistently track their expenses. By doing so, it can avoid overspending, and of course, it will help individuals or households to get a better performance for their financial management in consumer planning.
To conclude, consumer planning is more than just managing money. It is about building financial stability and freedom for the future. In today's world, where instant credit and online spending are so easy, having a smart plan is essential. We have seen consumer planning help to reduce debt, support saving, and encourage better budgeting. It is empower individuals to make informed choice about financial threats like emotional spending and build strong credit through the 5C, which is the character, capacity, capital, collateral, and condition. With strategy like tracking expenses, applying 1/3 rule, and communicating with creditor, anyone can take control of their finance, whether you are a student, parent, or young professional. Ultimately, consumer planning gives us the tool to avoid financial stress, achieve our goal, and protect ourselves from the issue like a bankruptcy.